Good afternoon and welcome to Airmic's special one-off webinar on the discount rate reduction. I'm Georgina Oakes, one of the Research and Development Managers here at Airmic, and today I'm joined by two experts on the discount rate, Luke Baker, Casualty Product Director at RSA, and Alistair Kinley, Director of Policy and Government Affairs at BLM. So what are we talking about today? I'm sure you all know in February the Lord Chancellor took a few of us by surprise by dramatically reducing the personal injury discount rate from 2.5% to minus 0.75%. The Lord Chancellor has accepted that this reduction will have significant implications across the public and private sector, and not least the insurance industry. So together this afternoon we'll be considering why the cut has happened, what the implications of the cut will be, and how Airmic members can respond. As ever, feel free to ask questions using the Q&A box on your screen, and if we don't have time to answer them all, as we often don't, we will respond to you directly. So over to our guests. First of all, I'm going to hand over to Alistair, who's just going to give us a bit of background info on the discount rate before we plunge into the detail. Alistair, over to you.
Thanks very much. Well, thinking about the discount rate, it's really just a way of calculating the net present value of a future income stream. And what happens in personal injury cases is that ongoing losses and needs, such as care in particular, are capitalised and a one-off lump sum is given at trial or settlement. And you need a discount rate, an investment rate, to adjust for the fact that whoever gets the money is going to invest that over time and make a return on it. And clearly, the higher the discount rate, which means you're assuming a greater degree of investment, the higher the discount rate, the lower the lump sum. And conversely, the lower the discount rate, the higher the lump sum at the outset that's needed. And that's what's happened recently. The discount rate was lowered by 3.25%, which, as Georgina said at the outset, has had a dramatic effect on personal injury awards. So thinking then about why the change has been made, well, the reasons for the change are really related closely to the laws it stands at the moment. The two constraining factors on the government minister, the Lord Chancellor, who's got responsibility for this. The first is that she's got responsibility and has to do it, and the second is that the way the law's been interpreted, you have to base the discount rate, that's the investment assumption for the damages, on the return of index-linked gilts, so government bonds that have an element of inflation proofing. And the Lord Chancellor in February felt she really had no room for manoeuvre at all and had to look at the returns that were being generated from those index-linked government bonds in order to reset the personal injury discount rate. And in fact, looking at those bonds, they're returning on average minus 0.75%, and that was the rate that was set, as opposed to what had applied for 16 years previously, which was positive 2.5%. So a dramatic shift, as I said earlier, of over 3% in the rate to be applied. And I understand Luke will come on later to provide some examples of just what effect that would have in practice on some case studies.
Do you think there's much potential for this to change? I mean, we mentioned a moment ago that the Lord Chancellor sort of feels that this has got a huge impact on the insurance industry and on the public sector too. Do you think they're going to review it as a consequence of that?
Well, there's just been a consultation on the possibility of reviewing it. We're in a difficult period. We're just about to have an election, so we don't know what sort of government's going to be returned and what their program's going to look like. But setting that all aside for the time being, the fact that there was a consultation so quickly after the new rate was set really strongly suggests that the government felt uncomfortable about doing what it was doing, but it felt constrained and it couldn't do anything else. So it seems to me that it's looking for a new way of setting the discount rate. And the way the consultation paper was constructed really suggests that it is looking for that new approach, and it's wanting some information that would help it set a new benchmark, perhaps away from the returns on index-linked government stock that I mentioned a moment ago.
And what about, is there any sort of challenge against that change?
Yeah, well, as I said, the election's the obvious elephant in the room over the short term, but if the law's going to change, we're going to need an act of Parliament to do so. That's certainly our view, and we need to be realistic of the prospects of that happening. There are quite strong legal, professional and other lobbies against changing from where we are at the moment. Any proposals in a new bill to change the rate, could get quite a tough scrutiny in the House of Lords and maybe subject to amendment. And lawmaking's always uncertain and unpredictable and can be hijacked along the way. And I think looking at the wider picture of the sort of UK political situation, this sort of law change probably needs to be done and dusted by late 2018. Otherwise, we're up against a kind of policy-making logjam of Brexit that's going to take everything over.
Exactly. Do you think that could be done before?
I think it could be done with a good following wind and minimal interference as it passes through Parliament. But it's far from a given. Okay.
Excellent, thank you. Okay, so that is sort of the discount rate, the cut and why. I'd like to spend the sort of bulk of this afternoon looking at the implications, and particularly the implications for our members, major insurance buyers. Luke, let's talk about sort of the crux of the matter, really. How are damages likely to increase?
Yeah, thanks. So clearly the impact on the overall level of damages is going to be significant, and I think that's really because of the compounding effect of this change over many years. So we know that the intent of awards are to reflect compensation for for ongoing costs and loss of earnings over the duration of claimants' lives, and which could be 30, 40, 50 years. And of course the compound effect of the 3.25% shift is significant over the course of that time. But I think for me the best way to bring it to life is to give some actual real life examples of the impact on individual claimants. So we've brought two here, which I think bring it to life. So we'll dive straight into the detail. So the first one here is an individual, 21-year-old male claimant, suffered a severe head injury in a road traffic accident. He'll never work and needs 24-hour care for the rest of his life. But there's been limited impact on his overall life expectancy. So based on the latest Ogden tables published, you can see that his life expectancy is still for an additional 66 years, with a 24-hour care at £135,000 a year. So the previous multiplier from a life perspective at 2.5% was 31.87, and the earnings multiplier was 27.71, with the overall cost of care at 4.3 million. And that gave a pre-shift of discount rate claim of £15 million. Now after the announcement, after the change in discount rate, that's changed materially, as you can see. So the life multiplier went from 31.87 to 87.14, and the earnings multiplier went from 27.71 to 56.95. The associated cost of care went from 4.3 to 11.7, and the overall cost of claim from 15 million to actually just under 30 million was 29.3 million. So you can see there a significant increase, a doubling broadly of the overall cost of claim to insurers.
And so I'm guessing that's sort of pretty standard across sort of all types of claims. I know you've got a second example.
Indeed, yeah. Of course, there are a number of variables that exist, in particular the age of the claimant and the extent of their injuries. But yes, for a case that has those characteristics, that's what we'd expect. That's what we'd expect to see.
And then your second example?
Yeah, so a little different in the variables here. So it's a 31-year-old female who suffered a spinal cord injury, but with less extensive ongoing care requirements, so paralysed from just above the waist down, which does impact the life expectancy by 10 years, but still the substantial life expectancy to indemnify for, so it's 59 years here, which is reduced by the 10 years just referenced. And here the life multiplier at 2.5% was 27.43, driving an overall cost of claim of 5 million. With the reduced discount rate, that then goes from the 27.43 to the 58.97, with a total cost of claim of 8 million.
So another huge
increase,
impact.
exactly.
Yeah. Okay, so that's the values. What about the actual types of awards that claimants are going to go after? Do you think you'll see much changes there?
Yeah, well, I think we will, but perhaps not that significant. I think driven really by the fact that periodic payment orders, which I think is the key point here, have never been that popular in my opinion, in my view. So I think PPOs will become less common again, albeit coming from a position where the uptake was not particularly high anyway. I think for me, and we've been talking about it over the course of the webinar so far, but this is a very fluid situation really. So we know that the discount rate's been changed. We also know that in the next 12 to 24 months it may well change again. And there's various other variables that affect, I guess, the overall negotiating point that we as insurers are going to take. So that means in particular that we're in arguably a stronger negotiating position, because I think claimants and claimant solicitors may not want to wait for longer than 18 months to settle, because they will know that actually at minus 0.75% that's probably going to change north in that time frame, and therefore rather than us taking to court, there is a negotiating point to be done there to land on a discount rate of greater than the minus 0.75%. Clearly, we'll maintain our negotiating position on on overall liability, any contributory negligence that exists. Make sure we ensure a focus on multiplicans, and as I say, take advantage of the uncertainty that certainly exists.
Okay. Okay, well, I think that gives us sort of an idea of what's going on in terms of the type and amount of awards. What about what risk managers can start to do? I mean, what efforts are being taken to reduce those claims? Alistair.
Yeah, thanks. And I think this very much builds on what Luke said a moment ago. I mean, frankly, the reality is for the next few months, any case that goes to trial is going to get an award calculated at minus 0.75% discount. No judge is going to depart from that because they'll be appealed and it'll be kicked back. So that needs to be borne in mind and dictate how you want to resolve cases in the next few months if they're getting ready for settlement. And be aware that the rate also applies in Scotland, and very probably in Northern Ireland, although there isn't a specific statutory rule yet in place, although the reality is that claimants will argue for it and may very well secure it. But moving away from that sort of level of detail and going back to Luke's point, I think where there are, in cases where there are significant differences in the expert opinion on life expectancy, there's going to be room for manoeuvre between the parties to strike a deal, and you need to back that up, your position on life expectancy, with sound expert evidence. And it may need refreshing given the recent discount rate change. That's certainly worth thinking about. A bit more as to the level of detail. Clearly, as Luke said, multipliers, the year's purchase that we're notionally buying, those have increased because of the discount rate, but the actual annual cost hasn't increased. So if we can do nothing about the multiplier because the rate's changed, let's look closely at the elements of the annual cost.
Right.
So each and every little bit of future care and each and every strand of loss of earnings and career development that's claimed for, make sure you're comfortable with those, put the claimant to proof on them if needs be, seek your own expert evidence and compromise, because we're not going to win the argument in the short term on the multiplier, but there might be some victories to be had on the multiplican, the annual amounts. And then really just to wrap it up, and again it's very much back to Luke's point about, I struggle to put it more elegantly than making the most of the uncertainty, but the uncertainty for all sides. It does look like the rate's going to change. That's not certain, and it's not clear what it would change to. So we're all in a period of uncertainty, and we can use that, I think, to create solutions where the defence side can reach a figure that they're comfortable with and meets their needs in terms of how they package that, and indeed the claimant side can probably reach a very similar figure which is comfortable with their needs and how they explain that to their customer base, in particular the injured person and their family and their advisors. So there is, as I say, to use that rather inelegant phrase, room to cut a deal in the uncertainty.
Okay, brilliant, thank you. Luke, I'm going to hand back to you, and I'd like to talk about something that our members are not surprisingly going to be worrying about, the impact on insurance premiums. What are RSA thinking in that sense?
Yeah, so I suppose the first point to note here is that actually the impact of discount rates are only part of the overall pricing environment that we all operate in. So clearly it impacts our view of what the right price is on a risk-by-risk basis. But equally, there's other pricing factors that we take into account as part of our day job, so normal claims inflation, and of course the overall movement around trade performance as well. So this is not a simple carte blanche increase of premiums across the board. It's very much each taking each risk and each trade on its own merits. So it impacts predominantly employers' liability, public and products liability, and motor insurance as the key large injury exposed lines of business. Our view is that the average rates across all three classes will need to increase. On motor more so than EL and PL, but clearly the damages environment has changed, and that should feed through into what the right price is. But of course that doesn't mean that every RSA client will have an average increase applied to it. That's clearly the wrong thing for us to do. More injury exposed trades should have an increase, but clearly trades that are exposed predominantly to property damage claims, it would be less appropriate for us to apply those increases onto. And clearly, well managed risks with a strong claims history and riddle rates being strong, all that sort of stuff should impact our overall view of what the right price is. And of course, one of the big impacts here is around reinsurers. So we'll think back to the impacts of those large losses, so from 15 to 30 and from 5 to 8. Now that's going to predominantly impact the reinsurance market rather than the direct insurer market. So there's a couple of key staging points really, I think, over the next 3 to 4 months to understand what that impact will be on the reinsurance market. It came out just before the 1/4 treaty season, and I know a number of the smaller treaties were extended rather than renewed. So for me, the next staging post from a reinsurer perspective would be the 1/7 treaty renewal season. I think at that point we'll have a clearer idea as to the overall impact of reinsurance spend across all direct insurers.
And I think we'll be touching on that actually a little bit later. Alistair, I know you provided me with some sort of figures on reinsurance, which we'll look at towards the end of the webinar. I'll hand back to you actually, Alistair, because you touched earlier on some of the key things that our members can be doing: scrutinising every element of the claim, securing robust advice on life expectancy, etc., and obviously taking advantage a little bit of the uncertainty at the moment. What will your top tips be for risk managers now, if we sort of narrow it down?
Yeah, I think the headline message really is comes from the examples that Luke just gave. He got 2 examples going from 15 to 30 million overnight because of the rate change, and one going from 5 to 8. A business facing those claims is going to have to be confident in its level of cover, that it's going to meet the need for that amount of cash, because if it doesn't, it's going to stand liable for any excess over its policy limit. So make sure that your level of liability protection matches your exposure. And that's probably worth a conversation with your buyer or if you're or your insurance advisor. And frankly, I think that really is the key takeaway. Anything else is kind of detailed, but it's really important. And we're in a world now where the 10 million plus UK personal injury claim is a commonplace, and it's not just an exception. And there are some policy limits out there that don't provide that level of cover, and people are going to have to really look at those and decide how they can best service their needs. Because if a business, particularly a small business, is faced with a claim of that nature and they've only got 5 million worth of cover, they are just going to go bankrupt. And that, with all the consequences for not just the claimant but the people that work there in the business itself. So that's one thing to look at. That's, if you like, the balance sheet risk as well. And I think with these increased claims values, you're probably going to see potentially other companies drawn into the claim, because at the moment, say if you'd got a 4.5 million claim and a 5 million policy limit, that's probably going to be fit for purpose. But if that goes up to, say, 8 or 9 million, to use Luke's example, it might be worth bringing another defendant in, alleging a small degree of negligence to access funds that would allow the claimant to top up what's going to be a shortfall because of the policy restriction in the first defendant. So more businesses could get drawn into these claims, and there's cost and delay and confusion as a result of that. That's worth watching out for. And I think the third strand to this policy limit point is that, a bit like the discount rate itself, the minimum level of cover for UK EL policies hasn't been reviewed for more or less 2 decades. And it stands at 5 million at the moment. I know the market offers 10 million fairly conventionally, but even on some of Luke's examples, that 10 million might not be enough. So maybe buyers and providers need to look at the levels they're providing, as I said, but also in due course we might actually see the government review the UK statutory minimum for EL cover to bring it up to a level that would be more commensurate with the exposures in the claims world today. Okay,
thank you. You mentioned that people should be talking to their brokers now, talking to their insurers, reviewing their limits. I'm assuming that would be a variation in terms of the Insurance Act on if they had to up their limits right away on existing programs. Something worth thinking about?
It's certainly something worth thinking about.
Yeah.
And I think whether it's a variation or not, one needs to be clear as to what basis that extra protection is being provided on.
Okay.
It could just be an extension by agreement to the term of an existing policy until it becomes renewed, or it could be a variation.
Okay.
But both sides need to be clear of what they're doing.
Yeah. Excellent. Okay, well, we're I'm coming towards the end of our webinar now, but I wanted to take some time to look at the reinsurance impact. Luke obviously referenced it earlier, but as I said, Alistair, you've got some nice figures for us just to put it into some context.
Yeah, the table on this last slide really is just to show where the increase due to the discount rate is going to bite, and then obviously it's going to create a new top slice of the claim. And you'll see that the example there is we've got a claim that was 6 million quid, and the policy was 5 million primary layer and 5 million reinsurance, and 5 million picked up by the primary carrier, 1 million picked up by the reinsurer. At a negative 0.75 discount rate, the value rises to 7.75 million. Primary layer still pays 5 million, but the reinsurer now has to cough up 2.75 million. And that's an increase of 175%, nearly doubling their liability, whereas the overall claim value has gone up by barely a third. And really the point of that example, and it's not an uncommon one, is to show the huge gearing effect on excess of loss reinsurance in particular. And that is going to affect the price of providing that protection, as Luke hinted at, and we'll get more intelligence as to the extent of that movement on the 1/7 renewal. But it also, in addition to just affecting the price on individual treaties, it might affect the risk appetite of reinsurance providers. They might decide not to offer these sorts of covers, or they might decide to limit who they do business with, or indeed there might be a drop in capacity of the market if the market conditions were such that that was a strategy. And all of those things could drive up the price for purchasers, in addition to what we've seen as increased claims costs. So there's, again, some uncertainty, significant uncertainty as to reinsurance rates and behaviours, for the quite near future, actually, if you look to 1/7.
So essentially the message is uncertainty abound at the moment, really, but it's something to keep monitoring. Talk to your brokers.
Yeah, and of course the same principle applies to the structure of direct insurance programs where there's excess layers in play, whether it's reinsurance or direct. So if there were a primary 5 or primary 10 million EL or PL policy, and then a 5x5 or a 10x10, there will be a clear exposure in those layers, which you would argue should be reflected in the price. So it'll be interesting to see if the excess layer markets, independent of reinsurance, change to reflect these amendments.
Okay. Gosh, right, so lots of things to watch out for then, basically. Okay, well that is actually, we've got through all of our content today, a few minutes ahead of schedule. Everybody who's listened in, or anybody who was registered and didn't manage to dial in today, I'm going to be putting all the slides and audio from this webinar onto our website within the next 24 hours, along with the contact details of both Luke and Alistair if you have some specific questions about your risks or your insurance program. Contact details are on slide 1 as well. We're going to have a pause in our webinar series. We've obviously run about 7 webinars already this year, but now here at Airmic we are pretty busy preparing for the Airmic conference, Birmingham, 12th to the 14th of June. I'm expecting about 1,700 people in attendance in Birmingham, so register ASAP so you don't miss out. And I will be back running more webinars on some of the technical papers that are coming out after the conference later on in the summer. So thank you for dialing in this afternoon, and speak to you soon. Bye-bye.